Following Donald Trump's recent election victory in the US, markets are anticipating a return to his America First approach, which could impact global trade, the dollar, and precious metals like gold and silver. Trump's policies are expected to include tariffs on Chinese imports, possibly leading to trade tensions and global supply disruptions, which historically have added volatility to equity and currency markets. As a result, this could weaken the US dollar, particularly if Trump follows through on expansionary spending promises without offsetting tax hikes, thus heightening inflationary pressures. For gold, the outlook is bullish, as Trump's policies may lead to a mix of fiscal stimulus and high geopolitical risk. The environment typically benefits safe haven assets, driving gold prices higher amid rising demand for hedges against potential dollar weaknesses and global uncertainty. Silver, often tracking gold but with additional industrial demand, could also see gains, especially if Trump's pro-manufacturing policies boost industrial use and stimulate silver demand. Okay, folks, welcome back to another update. Today we're looking at the US dollar, gold and silver. Before we go any further, make sure you hit that like and subscribe button to support the channel. Now, as you will mostly know, there's been a US election recently, and I'll try to keep this unbiased and just look at what's happening with these three instruments. So first, looking at the US dollar, on the trends, on the monthly, you can see that it's broken up into the bullish, or the neutral range, I should say, after being bearish for a number of weeks. Now, it's been fluctuating in that range, and that happened to be, if I zoom out, that happened to be our minimum target range, or the Fibonacci retracement of this bearish divergence. So it's been fluctuating in that range, hasn't actually broken out of it yet. Had a couple of attempts below that 38% retrace level over those couple of years, but hasn't actually broken out of that range yet. Now, on the weekly, it's broken up above the moving average of the CCI, giving us a bullish move, likewise above the moving average band. And on the daily, we did actually see this move break below a very thin or narrow moving average band on the CCI. It broke below that on the daily, and then it finally broke above, with the US dollar strengthening after the US election result going to Trump. Now, going to the intraday charts, again, we did initially say go short only when it broke below if you're trading on the intraday, but we did also project this, let's get rid of those arrows, we did also project this bearish divergence. We had that lower highs on the CCI versus higher highs on the price, and on our last video we expected it to hit this Fibonacci range. So if I expand that and redraw the Fibonacci retracement from that high down to that low, that was a 23-38% target range. As you can see, it hit it perfectly and then bounced for that. Now, with these retraces, it doesn't necessarily mean that it's going to crash, the price is going to crash, or it doesn't mean it's going to come into this range. It could do one of three things. You could bounce out of it like it did here perfectly. It could subsequently hit that range and stay in that range for a number of, in this case, hours, as you saw it did that on the monthly, or it could fall further and fall way below that minimum range. Now, what it's done in this example, it's hit that 23-38% level and bounced. And at the moment, it's actually gone higher. Now, if you're trading this, you would have taken long trades only, and that you'd be long positions only. Now, you would have missed that potential trade there. Again, don't trade in isolation on the one time frame. You always trade in the direction of the higher time frame. So if you were trading bearish periods, you would have taken short trades during that period there and closed it out when it hit that at the very bottom there. You would have closed it out when that CCI hit that moving average range there, if you're tracking it in line with that short positioning on the daily. So that would have been a safe trade to take, and you would have closed that out on that candle there when it hit that CCI range. Now, since then, it broke above the moving average range, and had you been following that on the daily, it would have been hard to check exactly where that broke above. But you can see that when it broke above on that candle there, that's showing us break above the daily CCI as well, and that would have been a trade to take, and then closing it out on that red candle there when CCI hits that moving average range. Now, at the moment, taking long trades only, the CCI on the daily is bullish, but the CCI on the 1 hour in this case is bearish. So avoid going short or long until we see the 1 hour break above the moving average range to go long. Alternatively, hold on until we see this CCI on a daily break to the downside. And again, it's a very thin moving average range. Could well do that. So we'll see how it goes in the coming hours. Now looking at gold first off, again we're looking at the trends on the monthly, the weekly and the daily. On the monthly it's been bullish now for a number of, or most of this year and a bit of last year, since about November 2023. And we did have a bearish divergence here. You can see there it broke down, hit our initial target. Now one thing I don't do often, but I'll do it in this case, I'll draw a Fibonacci extension from that low and that range. Now what you can see here is the price is currently sitting around the 100% level. Now will it go any further? Will it reach the 123 level, around 3100, or will it stagnate there at around 2720 and start pulling back from there? So the reason I say it may pull back, you can see that it's slightly weakening so far this month, but if you look at the weekly, we've got a bearish divergence here on the weekly, and that's already broken to the downside below CCI moving averages. And I've drawn a target there. That's a minimum target. Again, always emphasize it's a minimum target, and more than 90% of the time it hits that minimum target. And that's between a 23-38% level, and it's on its way to doing that possibly. We always take this one step at a time. And on the daily, you can see there we've got in between that range there's a lower highs on the CCI versus higher highs on the price. Hit that resistance at 27.90. And if I was to draw a Fibonacci between that little range there, we take it back to the significant recent level. So the retrace level will go from that high, and that Fibonacci range is that divergence range starts there. So we'll take it back to this range here. You can see there it's already hit that minimum target range, that 23-38% level. Now it could bounce from there, or it could keep falling further. The CCI is still looking like it's actually continuing to fall. Now you might argue, okay, let's take it back to the recent, that significant low there. It's already hit that 23-38% level as well. So either way you draw it, and that goes back to that recent low, it's already hit that minimum target range. So that's on the daily. Again, if we go to the intraday, taking short trades only, you can see there that would have been a nice little trade to take. If I draw the short arrows, you would have entered there, and you would have closed it out near the bottom there on that candle there. If you're following the CCI breaking into that moving average range, that would have been your exit point on that little candle there once that CCI hits. So at the moment, predominantly short trades on the intraday. Wait for this to break to the downside again before taking any short trades. So now looking at the silver price, looking at the trends again on the monthly. Again, you can see a very bullish, has been since around February 2024. And it's also bullish above the moving average range. Now if we drill into the monthly chart again in more detail, drawing a Fibonacci extension, you can see if we go from that level, let's take it to this level, you can see there it hit the 200% Fibonacci extension. These can be a bit subjective in terms of where you draw these extension lines on the Fibonacci's. And if we take it in a smaller time frame between that range, you can see there the price hit just it's fluctuating currently around 100% retrace level, and that's on the monthly. So again, we've got a bit of a retrace to the downside at the moment on the month, similar to gold. We'll see where that goes. Now on the weekly, we did have another bearish divergence here versus high highs on the price and hit our target range. So that was between that significant low there to that high. But even if you drew that Fibonacci down to that level, you can see there it's actually just touched that 23% level, even if we extended that Fibonacci range. So that sometimes these Fibonacci's can be a bit subjective, but at the moment on that smaller range, it's hit that target. And we always take it back to the recent low before that divergence started. That's why I've taken it back to that level there. That's on the weekly, and it's still like it's dropping off. The CCI is still dropping off, so no sign yet of a pullback to the upside. On the daily, that sort of supports that view as well. We did have a small divergence back here, broke down, hit our target. You can see there from that to that point, that was a 23-38% level. I won't draw the Fibonacci's. And there was no divergence here, but you can see there the price and the CCI were in alignment and falling off, both falling below their moving averages. And the CCI is still dropping, so still a weakening outlook for silver on the daily at least. If we go to the intraday charts, again taking short trades only in alignment with the daily, you would have taken short trades from there. And you would have had a small little trade there, close it out when it hit that CCI, hit that moving average band, and re-enter it again when it broke down through that CCI, and you would have closed it out on that candle there when the CCI hit the moving average range. So again, I prefer to take trades when they in and out of those moving averages of the CCI, as opposed to the price moving averages, because you can lose some profitability when the price retraces to that level higher than compared to the CCI range. To support the channel more, hit that like and subscribe button and share the video. For added benefits and the cost of a coffee, consider subscribing to the Patreon page, where we look at weekly scans of bullish trending shares and insider trades that may have occurred. Thanks again, and see you in the next video.